convidada especial, a professora Esra Ugurlu, da Universidade de Leeds. A Esra fez o doutorado na UMass, Universidade Heterodoxa dos Estados Unidos. Trabalhou com os professores como Peter Scott e o Aslan Hansme. E hoje em dia ela dá aula na Universidade de Leeds, na Inglaterra. Ela trabalhou sobre temas como bancos públicos, financiamento do crédito às famílias, financiarização, e hoje ela vai apresentar sobre a relação de investimento com uma resposta à falta de trabalho, né, em alguns setores específicos. So, thank you, Esra, for being here. We will now see our presentation about investment response to labor scarcity in Europe. We have 34 minutes, so please. Thank you.
Thanks very much, Ricardo, and thanks everyone for coming. Before I begin, I would like to thank both Ricardo and Carolina for organizing this seminar. It's a really great pleasure to be here. It is my first time in Rio, first time in Brazil, so I'm very excited and feeling honored to have the opportunity to present here. So the title of my presentation is slightly different than what I originally provided, but the content is the same. And the presentation is at the moment based on what is two different papers, but it might merge into a single paper. And my co-authors are Edinoglu Baker and Michael Stammer. Let me first tell a little bit about why we're focusing on this concept of labor scarcity. I'm originally from Turkey, a country a bit similar to Brazil than Western economies that my research is at the moment focusing on. And growing up in Turkey, labor scarcity was not really, something that I think I ever observed or really told much about at the university, because until recently, Turkey has been characterized as a country with what Archduke and his followers would call unlimited supplies of labor. But since moving to the West, labor scarcity became a more kind of prominent issue in my thinking about the economy, because whenever I open the news, these are all, for instance, taken from Financial Times, there's an article about how labor shortages or labor scarcity is affecting economic activity in different sectors across Europe. So examples from food production to chip-making industry, from childcare to home. So this seems to be a very widespread issue. But interestingly, when we look at the kind of academic literature, there isn't really a lot that's been written on analyzing the effects of labor shortages from a macroeconomic perspective, and especially the relationship between labor shortages and investment. So we think that there is a bit of a gap in the literature. This is an important topic that is widely covered in the media, in policy and public discussions, but there isn't really much academic empirical work on this question. And from a theoretical perspective, we think that the sign of the relationship between labor shortages and investment is not a priori clear. And the reason is that this relationship is likely to depend on whether capital and labor are complements or substitutes in production. So if capital and labor are complements in production, labor shortages is likely to affect investments negatively. So just to give one example, a construction company might not be interested in purchasing a new crane to expand their activities if they think that they won't be able to find the workforce that is necessary to operate the crane. But in some other sectors, capital and labor might be substituted. So when you go to restaurants, it is increasingly becoming more kind of common for restaurants, for instance, to replace base staff with QR coded menus. Or at supermarkets, at an increasing rate, we see kind of self-checkouts. So it might also be possible to substitute capital and labor, and this might be particularly the case when labor is in shortage. And there's, we think, a third way through which labor shortages can affect investment, and that is through the relations of production. So in an economy where labor is scarce, that might give more bargaining power to labor. And if workers' bargaining power translate into lower profitability, that could negatively affect investment. So basically, whether the relationship is going to be positive or negative is not really clear. So we think this makes this question a good candidate for an empirical investigation. So that's the motivation behind it. So we look at how labor shortages affect investments, and we also want to analyze different channels through which labor shortages can affect investment. That's the project. And we think that based on our review of the literature, this is one of the first studies to analyze this question in the context of European Union countries using a data set that is relatively broad. So speaking of our data sets, we address this question at 3 different levels of aggregation. We start with a cross-country Canal data set that covers 24 European countries. Then we move on to an industry-level data set. So we use a measure of labor shortages that we have taken from business and consumer surveys, and we match this data with a different data set by EU plans. And finally, we also look at the question using firm-level data. So we got access to a firm-level survey that is conducted by the European Investment Bank, and in the survey, firms are asked all sorts of questions about their investment activity and factors that prevent them from investing, including labor shortages. And we match this data set with Orbis database, which is a very commonly used firm-level database. And in case I don't have time to go through everything, I want to mention some of our results. So when we look at this question using more aggregate level data, so our cross-country and industry level data set, we always obtain a positive sign. So there seems to be a positive kind of correlation between our measures of labor shortages and investment. But we think that aggregate level data masks some important differences across firms and across sectors. So when we work with our much richer and more granular firm-level data set, we notice that the effects actually depend on which sector we are looking at. So to give an example, in the manufacturing and construction sectors, we find a negative relationship. And our findings are particularly robust for the construction sector. We have some question marks about the manufacturing sector that I will come back to. But in the construction sector, we observe a consistent negative relationship between shortages and investment. And this fits, we think, quite well with some of the anecdotal evidence that we read every day on the media. So we're not too surprised about the results. But when we look at the service sector, we observe a positive relationship, and we have some potential explanations about why labor shortages might be inducing service sector firms to invest in technology. So when I talk about investment in this presentation, it's not just capital investment, it also includes investments in intangible assets. And we have certain hypotheses about why labor shortages might be affecting investments in the service sector in a positive way. So that's the overview. Let me now talk a little bit about some of the literature that our paper speaks to. And so there's this literature by Ugurlu and his co-authors analyzing the relationship between aging population, innovation, and economic growth. So in this studies, the authors don't necessarily look at how labor scarcity affects investment, but they analyze the correlation between having an aging population and how that kind of correlates with per capita income. And most of their findings point to a positive kind of relationship. So they seem to suggest that capital and labor can be substituted, and labor shortages might be inducing firms to invest in labor-saving technological changes. But labor shortages also appear in the secular stagnation literature. But quite interestingly, in the secular stagnation literature, the contributors to this literature are a bit more pessimistic about how an aging population affects growth across rates. So they seem to indicate a negative kind of relationship between measures of an aging population and economic activity. Then, given our kind of background and interest in post-Keynesian economics, we also analyzed the post-Keynesian literature on investment functions, and there's a vast empirical literature. There are also very kind of heated debates about how to specify an investment function. So those of you interested in the school of thought, I'm sure familiar with some of these theoretical debates. But in general, our sense is that it's not really possible to kind of pinpoint a very generalized post-Keynesian theory of investments. And based on our analysis of the literature, we don't think that post-Keynesians pay a lot of attention to the kind of interactions between labor and good markets, especially when it comes to theorizing investments. So we kind of feel like there's also a bit of a gap in this literature that we can perhaps speak to. But we draw a lot from the post-Keynesian literature, especially when it comes to how to specify our investment functions, what kind of control variables should be. So we don't think that the post-Keynesian literature addresses our question, but it is quite informative for us in terms of helping us decide what kind of control variables we need to have in there. And finally, the final kind of strand of the literature that I want to mention is a bit more empirical and a little bit more really atheoretical. So we specifically looked at whether there are any studies that analyzes very directly the effects of labor shortages on investment activity. And so far we could find only one paper. And this is a work in progress. We couldn't even access the actual paper, but there's a blog post where authors explain in detail what they do. So they look at earning calls of firms from the US, and they apply some text analysis methods to create measures of labor shortages. And they look at the correlation between their measure of labor shortages and investment. And they find a positive relationship. So this paper is basically the closest paper to what we want to do, but we also differ in some important ways. So our measure of labor shortages is very different. It comes from a survey. It is based on firms' own perception of labor shortages. And we also look at European countries instead of the US. So in that sense, we see our paper as complementary to this study. And there are just one or two papers that use similar survey-based measures of labor shortages, but they don't look at the effects of shortages on investment. They rather focus on drivers of shortages or the effects of shortages on wage and employment. Basically, the kind of picture of the literature. Then I want to talk a little bit about our conceptual background. So we don't have a kind of a formal model to motivate our empirical exercise, but we have a mental model. So we use this diagram, it's called a DAG, to kind of understand causal relationships, potential causal relationships between our variables of interest. So we have labor shortages here and investments here. And we think that there are basically 4 different channels through which labor shortages can affect the investment rates. And I will now very briefly try to go over some of these. So first of all, we think that labor shortages can influence the investment rate through its effect on what we call desired choice of technique. So as I mentioned at the start of my presentation, shortages can affect firms' desired choice of technique, because if firms are finding it really difficult to recruit workers, then they might try to substitute workers with capital. So that's the key idea. And I think I already gave this example of restaurants already substituting a wait staff with QR coded menus, but one can come up with many different examples. And this idea of substitutability between capital and labor is something that is widely discussed in the kind of mainstream areas of investments, such as the adjustments cost literature deals with this question a little bit. And most of the studies in this literature argue that capital and labor are complements rather than substitutes. So we kind of test whether this finding is also compatible with our data. But in some cases, capital and labor might not be that easy to substitute. So if capital and labor are complements in production, then labor shortages can negatively affect expansion of output, and it can negatively affect investment rates. And this is an idea that we find in a number of contributions by Peter Scott, who was, I think Ricardo mentioned at the start, was my PhD advisor. So he introduces employment rates, which is widely used as a measure of labor shortages, to a very standard Barbarian investment function. So we have capacity utilization and profit share. And he argues that employment rate might be affecting investment rate negatively at the aggregate level if capital and labor are complements. But as far as we are aware, this functional specification hasn't been tested previously in the literature. Finally, as I mentioned at the start, labor shortages can affect relations of production at the firm level. It can increase shop floor militancy if basically workers have a better fallback position in a very tight labor environment in which they can easily find alternative employment. So that can affect profitability and animal spreads negatively and might have a negative influence on the investment rate. And this is an idea that goes back to Marx's capital volume. So as you can see, we take a little bit from our approach is a bit eclectic, so we take some insights from the Keynesian literature. We try to engage also with mainstream and Marxist theories of investment as well. So we think that at the macroeconomic level, aggregate demand might be a confounding variable in our empirical analysis, meaning that aggregate demand is very likely to affect investment. So that's something that we learn from Keynesian and post-Keynesian theories of investment, that demand is an important determinant. But we're also likely to face labor shortages in an economy where demand is very high. So we have to control for aggregate demand if we don't want to have any biased business. So at the country level analysis, we introduce capacity utilization as a control variable. At the industrial level, we try to purge the effects of demand shortages from our measure of labor shortages. And if my time allows, I will expand on this later on. And we think that using a granular firm level data already helps us mitigate any endogeneity problems, but we still, almost in all our specifications, have a measure of aggregate demand, because we believe that that is an important determinant of investment, because that's what the theoretical and empirical literature tells us. Second, we think that there might be some unobserved time-invariant or time-varying factors that could affect both labor shortages and investment. So whether a firm faces labor shortages might be a function of what region of the country they are based in. It might be a function of their sector of economic activity. It might be a function of some firm-level characteristics. So we always try to introduce different types of fixed effects to our specifications so that we can control for this type of time-invariant, unobservable factors. And we draw a lot from a paper by Royce and Sonderland. This is a European Central Bank working paper to understand the determinants of labor shortages, because that tells us something about what kind of fixed effects we need to control. Very briefly on our data, at the country level, as I mentioned, I think earlier, we have the employment rate as our measure of labor shortages. At the industry level, our measure is percentage of firms that identify labor shortages as a factor limiting their activity. And at the firm level, we have a dummy variable, which is equal to 1 if a firm reports that the availability of staff with the right skills is an obstacle for their investment activities. So as you can see, we kind of start with a proxy, a bit of a weight measure of labor shortages. And as our data becomes more granular, we think we are better able to capture whether there are labor shortages or not. And in our data set, so this is provided by the European Investment Bank, the firms are asked questions about different factors that could be constraining their investments. Labor shortages is just one of them. And firms can say, yes, it is a major obstacle, a minor obstacle, or not an obstacle at all. So that responses are qualitative. We thought that the only way of maybe turning that into a quantitative measure is to create a diagram. Very quickly, how our data looks. So when we look at the country level data, so this is the investment rate, employment rate, and rate of capacity utilization. There seems to be a positive kind of correlation between these measures. Our industry level data similarly paints a similar picture. So this is the investment rate, this is the percentage of firms identifying labor shortages as a problem. As you can see, since kind of the global financial crisis, there's an upward trend in the data. And this also largely positively correlates with capacity utilization. At the firm level, the percentage of firms identifying labor shortages as a problem always exceeds those who do not. So the data basically confirms for us that yes, this is a problem for firms. It is not something that kind of going on in our heads. So we're not making this up. Firms are consistently and increasingly complaining about labor shortages. And this is true across different sectors and true across firms with different sizes. Briefly on our firm level data, so our measure of investment rate is the growth rate of capital stock. And capital stock includes both tangible and intangible assets. And we match the survey data with the Orbis data set, and we clean this data set following some of the most kind of established practices in the literature. So all our variables are expressed in real terms. They're always measured in 2015 US dollars. So we did basically all the standard work to clean the data set. These are our empirical specifications. So we always base investment rate on a measure of labor shortages. We always always use one period lagged values. At the country level, we control for capacity utilization. At the firm level, we have a time varying vector of control variables that includes capacity utilization as well. Then, as I will show you in a second, we experiment with different types of fixed effects. So we always have either country fixed effects, time, or industry fixed effects. So let me now show you some results, starting with our country level results. So as you can see, employment rate always has a positive sign. It is always statistically significant. We also standardized our right-hand side variables to assess the economic significance of results, and we found out that the relationship, in addition to being statistically significant, is also economically significant, meaning that our measure of labor shortages explains a high percent of the variation in the investment rate after accounting for any country and time fixed effects. And this relationship seems to be quite robust across different types of specifications that are commonly found in the literature. So it holds if we include profit rate or labor share as a control variable. So this basically tells me that my advisor is maybe wrong. So his theory, his functional specification for investment rate with the negative side doesn't really have empirical support when we look at aggregate data. And we continue to find the same thing when we look at the industry level data. Here, the statistical significance depends a little bit on the way we introduce the control variables. So the results are not as strong when we work with the industry level data, but the sign is consistently positive across different types of specifications. But results change quite dramatically when we move to firm level data. So when we look at the firm level data, and this does not distinguish between any sector. So this includes services, construction, manufacturing, and anything else that don't fall under these categories. We don't find initially any statistically significant results. So after basically months of cleaning this data set, when I saw this table, I have to admit, initially I was a little bit disappointed. But results do get interesting when you look at different sectors. And you might wonder maybe why we have 4 different columns, but it looks similar. Basically, we have different types of fixed effects. We always have firm fixed effects, and then we try different kind of interaction fixed effects. So either country year, country industry year, and so on. Because we are not 100% sure what is the best way of introducing the fixed effects. There isn't really a consensus in the literature, so we try to basically present different results. And this insignificance continues when we introduce different types of controls. So we control for profit rate, we control for leverage, uncertainty, and so on. We also distinguish between firms facing major or minor labor shortages. It remains to be insignificant. But when we look at the manufacturing sector, in some of our specifications, we find some statistically significant results, and there seems to be a negative relationship. So if a firm is reporting that they're facing labor shortages, it looks like they also have lower investment rates. So this might be suggesting that maybe in the manufacturing sector, capital and labor are more complex. And this might sound...
This is a firm level?
This is the firm level.
Okay.
Yes. And this might sound maybe a bit surprising. Our potential explanation is that maybe firms in Europe already quite saturated in terms of they have maybe already substituted a lot of labor for capital, and maybe they kind of hit a limit. So that's one potential explanation about why we might be observing this negative relationship. But definitely something that we need to kind of dig into a bit to understand why this is. service sector, on the other hand, we observe a positive sign, and we think that this is explained mainly by intangibles. And I think with the kind of this unprecedented growth of AI and new softwares and technologies that now allow service sector firms to substitute labor, the result is maybe not that surprising. So that is our, at the moment, hypothesis, potential explanation for why we have this positive sign when it comes to the service sector. Well, one thing that we want to do is we want to distinguish in our next step between different types of sector, service firms, because financial services might be quite different than healthcare and childcare. So that's something that we are yet to analyze. Then we move to the construction sector, and we find this very consistent and highly statistically significant result. And for us, this really fits well with what we are reading on the media. So at the moment, currently based in the UK. And in the UK, the new Labour government is discussing a lot how to improve the infrastructure and how to increase the housing stock in the country. These are some of the most important problems that these countries are facing, that they have a very old infrastructure and housing is a huge problem across the country. And a lot of analysts think that the government is not going to succeed in addressing this problem unless they do something to address labor shortages, such as changing their immigration laws and regulations. And we think that our results are compatible, to say the least, are compatible with those kind of sentiments and arguments. Okay, so these were our results. How many minutes do I have? 10 minutes, that's perfect. Next thing, we try to analyze some of the channels that I mentioned when I showed that diagram. So we want to understand different mechanisms through which labor shortages are affecting investments. And I want to mention that this bit of the presentation, so these 3 slides are quite preliminary, and I'm going to caveat them a little bit. So as the first thing, we looked at how labor shortages correlate with labor productivity. So are firms trying to extract basically more from their existing workforce when they are faced with labor shortages? Or are they unable to do that because in an economy where labor markets are quite tight and hot, maybe workers don't have the motivation to be very productive because they have a good fallback position. So I don't know if you heard during the pandemic, there was this phenomenon of quiet quitting, especially among the millennials. Basically, people not putting as much effort into their work because they did not feel motivated to, and they had a fallback position. Yes, please.
Just to clarify, labor productivity is output per hour.
Output, no, total output per total number of employees in real terms. Maybe we should also check per hour, but at the moment, total output divided by total number of employees and output is in real terms. It seems like labor shortages and labor productivity kind of negatively correlated, so maybe that has some at least coherence with that idea of quiet quitting. So labor is not very productive in Europe. But we think that we need to think a little bit more about our specification. We need to think a little bit about if there could be any time varying variables that determine both labor shortages and labor productivity. So these are kind of preliminary set of results. Next, we looked at the effect of shortages on the capital labor ratio, because that is kind of a commonly used measure of choice of technique. We have significant results only in the construction sector, which makes sense because we found negative effects of labor shortages on investments in the construction sector. And this kind of suggests that capital and labor are very complementary in the construction sector, which makes also some intuitive sense to us. But one kind of challenge that we are facing with this table, and if there are any kind of suggestions we will be very interested in hearing, is that firms would change their choice of techniques, so the way they produce things, only if they are convinced that labor shortages are not a temporary phenomenon. So the timeline mentioned is quite important. So if they think that they are just in a particular part of the business cycle and labor shortages are going to go away, they may not just change the way they produce these that easily. So we need to find a way of separating between short-run and long-term effects, basically. We have some ideas about how to approach this. So one idea is to slightly play with our measure of labor shortages and record labor shortages if firms have reported, let's say, for the past 3 years that they've been suffering from this problem. But if there are any other kind of ideas about how we kind of approach this conceptual problem, that would be really appreciated. And secondly, we again need to think a little bit about our specification and how we can refine that further. We are aware, for instance, that we probably should control for relative price of capital. So if capital goods are becoming really cheap, that could basically push firms to substitute labor for capital. So we need to refine this set of results a bit. So I want to caveat. And finally, we look at whether labor shortages affect labor share of income at the firm level. So this is our reserve army channel. When we use labor share as a measure of kind of workers' bargaining power, relative position vis-a-vis capital, we don't find statistically significant effects. As the next step, we want to replace labor share with growth of wages to see maybe their wages are growing, but that's not necessarily translating into higher wages. So that's something that we plan to do. So to conclude, or before concluding, maybe given that this is an empirical presentation and a paper that may mention that we have done some robustness checks. So when we work with country level data, we replaced our OLS estimations with GMN. We find very similar results. And we also tested the stability of our results to excluding certain countries or industries once at a time to see if there are any kind of outlier countries or sectors that determine our findings. So far, things seem to be relatively stable. So in the next step in this project, we want to refine some of our regressions, especially when it comes to analyzing the channels. And we also want to basically explore some moderating variables. So under what conditions labor shortages affect investments more positively or more negatively. So that's something that we plan to do as our next step. So just to kind of wrap things up, so far, this study tells us that the effects of shortages on investment depends on the sector of economic activity. In the manufacturing and service sectors, results are a little bit sensitive to the way we introduce the fixed effects, so we need to dig a bit deeper. But when it comes to construction sector firms, we find consistently negative effects. And to us, this tells us that European countries that suffer from an infrastructure and housing deficit might benefit from adjusting their immigration rules to alleviate labor shortages. That's one potential implication of this study. But of course, immigration policy is not the only thing that countries can do. So investment in education, especially preschool education, could be another way of addressing this problem because that could allow more women to participate in the labor force. And as I mentioned at some point in the presentation, our findings, especially for the construction sector, fit quite well with the kind of analysis that we read on everyday media in terms of how European countries might struggle with this problem if they don't really either relax labor shortages or invest more in their preschool education. So that's everything. Thanks very much, and I'm really looking forward to any criticisms, comments, questions. As I mentioned, this is still relatively early stage, so please don't hold yourself. Feel free to give your kind of toughest questions or comments. That would be great.
So can you